The price signal nobody's talking about. Silver just hit $78 an ounce in Shanghai. At the same exact moment, the paper price on the COMEX in New York was $72, a $6 gap. Elon Musk said, "This is not good." He's right. But the problem is bigger than one executive's supply chain. Mainstream coverage tells you this is about industrial demand, solar panels and electric cars. That's the surface level story they want you to believe. It's intentionally misleading. Because when you look at that $6 price gap, you're not looking at a simple commodity rally. You're looking at a fracture in the global financial system. That gap defies the most basic rule of markets: arbitrage. Traders should be buying cheap COMEX silver and selling it for a profit in Shanghai. The fact that they aren't or can't tells you everything. China isn't just participating in the silver market anymore. Starting January 1st, 2026, they're restructuring it. This is about control, not commerce. We're going to trace the decade-long strategy that led to this moment, exposing the three mechanisms China uses to control a resource the modern world can't function without. The mechanism, how China controls what you can't see. Let's start with what's actually happening right now, because the mechanics reveal the strategy. The first mechanism is export controls as gatekeeping. On January 1st, 2026, new licensing requirements come into effect. To qualify, a company must agree to produce at least 80 metric tons of silver annually. That's a threshold that eliminates small and mid-size exporters overnight. This isn't a ban, it's strategic ambiguity. China can claim they're just regulating a critical material for compliance, while functionally choking the global supply. We've seen this playbook before. Look at rare earth elements in the early 2000s. China reclassified them, imposed export quotas, and watched as prices soared and Western governments panicked. It took over a decade to partially rebuild non-Chinese supply chains. This is the same structure, but the stakes are exponentially higher because silver is not a specialty metal. It's in everything. The second mechanism is state buying through state-owned enterprises. Here's a critical detail most analysts miss. China doesn't control 60 to 70% of global silver mining. They control 60 to 70% of global silver refining. That's a monumental difference. It means the raw ore mined in Mexico, Peru, or Australia very likely passes through Chinese infrastructure before it becomes a usable industrial metal. State-owned enterprises use this position to lock in long-term supply contracts at today's prices, while simultaneously preparing to restrict the outbound flow. They accumulate physical metal while the paper market is distracted. This creates a perverse arbitrage. For a while, traders could buy paper silver on the COMEX, ship it to Shanghai, and sell the physical metal at a premium. But that game ends when the metal simply doesn't leave the country. The arbitrage opportunity vanishes, and with it, the mechanism that's supposed to keep global prices aligned. The third mechanism is the Shanghai Futures Exchange inventory dynamic. Physical silver in Shanghai now consistently trades $5 to $7 above the paper price in the West. This premium persists, defying the theory of efficient markets. Now look at the inventories. COMEX registered inventory, the silver actually available to settle futures contracts, sits between 120 and 130 million ounces. That sounds like a lot until you realize it's only about 10% of annual global demand. Meanwhile, Shanghai stockpiles are at 10-year lows, and Western vaults have been hemorrhaging metal for years. This points to the core weakness, the paper-to-physical ratio. Some estimates suggest it's as high as 378 paper claims for every single physical ounce in certain ETFs. 378 to 1. The entire Western financial edifice for silver is built on an assumption that most investors will never ask for delivery. It's a system of trust, not metal. China's market operates on a different principle. Shanghai pricing reflects the cost to store and deliver actual, usable metal inside China. When that price rockets $6 above the paper price, it's the market forcing a brutal repricing. It's physical reality asserting itself over financial engineering. Why does this matter so much? Because silver's demand is inelastic. If the price of coffee doubles, people drink less coffee. If the price of insulin doubles, people still buy it. They have no choice. Silver is the insulin of the modern industrial economy. It's in every solar panel, electric vehicle, military system, and AI server rack. Industrial users can't wait for prices to drop. Their production lines need the metal now, and the supply cannot quickly respond. Roughly 80% of silver comes as a byproduct of mining copper, zinc, and lead. You don't get more silver unless you mine more of everything else. New primary silver mines take 10 to 15 years from discovery to production. So you have inelastic demand, constrained supply, and now a single actor controlling the refining choke point and the export gate. This isn't a market disruption, it's the execution of a plan. The timeline, China's decade of strategic positioning. This didn't happen overnight. To understand the endgame, you need to see how China positioned itself over the last decade. This isn't a reaction to current events, it's the culmination of a long-term strategy. The foundation was laid between 2015 and 2017. This was the infrastructure phase. China aggressively expanded the Shanghai Gold Exchange and began promoting the concept of a gold corridor, a system for settling international trade in gold, stored in vaults across allied nations. At the same time, they were closely watching global banking regulations, specifically the Basel III framework, which began positioning physical gold as Tier 1 collateral. The lesson wasn't lost on them. Monetary credibility is tied to tangible assets. But there's a deeper historical lesson here that China learned the hard way. In 1934, the United States passed the Silver Purchase Act. The US government began buying massive amounts of silver, driving the global price up. For China, which at the time operated on a silver monetary standard, this was catastrophic. Silver, their money, was pulled out of the country to be sold at higher prices abroad. It triggered deflation and economic collapse. The lesson was seared into national memory. If your economy depends on a material you do not control, other nations can and will weaponize it against you. From 2018 to 202, China entered the accumulation phase. While Western markets were obsessed with financial engineering and stock buybacks, Chinese state entities engaged in quiet, consistent buying of physical silver. They weren't speculating on price, they were building a strategic position. Simultaneously, they expanded their global refining dominance and deepened relationships with primary producers in Mexico, Peru, and Bolivia. The focus was entirely on physical control of the supply chain. Then, from 2021 onward, the structural deficit they were banking on began to emerge in the data. The world entered 4 consecutive years of supply-demand deficits, totaling an estimated 678 million ounces of silver. In 2024, industrial demand hit a record 680.5 million ounces. Demand wasn't just high, it was structurally outstripping supply by a wide margin. And during this period, COMEX and London vault inventories plummeted, down 40 to 70% since 202. Yet the paper price, set in New York and London, remained artificially low. The disconnect between the paper market and physical reality was widening, and China's stockpiling continued. 2025 is when the squeeze became visible. Silver surged over 150% as the announcement of the new export rules approached. The Shanghai premium widened to unprecedented levels. Western manufacturers and ETFs, which had operated for years on the assumption of limitless paper liquidity, began scrambling for physical delivery. They started to discover the fragility of the system. By December 2025, traders were paying a 7% premium for immediate delivery versus waiting a year, a clear signal of panic in the physical market. All of this sets the stage for January 1st, 2026. That's when the mechanism becomes fully operational. The export licensing regime goes into effect. On paper, it's a regulatory change. In practice, it's a valve. China can now prioritize its own domestic manufacturers, its solar panel producers, its EV makers, with access to cheaper local silver. Foreign buyers are pushed to the back of the queue, facing uncertainty, delays, and extreme price volatility. The timeline reveals a critical truth the mainstream narrative ignores. This isn't a sudden policy shift driven by trade tensions. It's a deliberate, decade-long campaign to move from a position of vulnerability to a position of control. They studied the historical playbook, the 1934 Silver Purchase Act that was used against them, and they are now executing that same playbook, but in reverse. They are not subject to the weaponization of a critical commodity. They are becoming the ones who hold the weapon. This strategic positioning turns silver from a simple industrial input into a form of geopolitical leverage. Control the processing. Control the export gate. Then you don't just influence price, you influence who gets to build the infrastructure of the future. You decide which countries can scale their solar energy capacity, which manufacturers can produce the next generation of electronics, and who has to come to the negotiating table. The last decade was about building the apparatus for that control. Now the apparatus is being switched on. What this reveals about the system and what to watch. This entire situation is a stress test for the Western financial system, and the system is failing. It reveals a fundamental weakness decades in the making, the reliance on paper markets to suppress the price of physical reality. For years, price suppression through derivatives and ETFs kept silver artificially cheap. This wasn't an accident. It benefited Western economies by providing low industrial input costs, but it created a dangerous illusion. The COMEX system was never designed to deliver physical metal at scale. It was designed for cash settlement. It works only as long as everyone agrees to pretend the paper claim is as good as the metal. China's actions change that behavior. When buyers start demanding delivery, the structure breaks. This is the leverage play. Control of refining plus control of exports equals control over who builds what. AI infrastructure, renewable energy, military electronics, none of it happens without silver. China can now influence which countries and companies can access the material needed for these strategic industries. This isn't about making money on higher silver prices. It's about technological and industrial leverage. Think of it as OPEX leverage, but for the entire electrification of the global economy. So what should you be watching? The data points that signal escalating stress. First, monitor the Shanghai COMEX price spread. That $6 gap is your canary in the coal mine. If it widens further or becomes permanent, it signals that physical silver is becoming unobtainable through normal channels. It means the arbitrage mechanism is broken. Second, track COMEX registered inventory levels. The number to watch is 100 million ounces. If it falls below that threshold, the system's buffer is gone. The paper market's claim to legitimacy rests on there being some metal available. Below 100 million ounces, that claim becomes untenable. Third, observe the licensing approvals from China's Ministry of Commerce in the coming months. Who gets permits and who doesn't will reveal Beijing's strategic priorities. It will show you which alliances and which industries they are choosing to support or hinder. Fourth, pay attention to the behavior of industrial buyers. Are major manufacturers announcing supply chain disruptions specifically for silver components? Are they publicly stockpiling or seeking alternative suppliers? Their desperation is a direct indicator of physical tightness. Finally, watch for the official admissions of failure. If Western governments suddenly announce programs to build strategic silver stockpiles, that's not a solution. It's a confession of vulnerability. It means they've recognized the system they built is defenseless against this form of pressure. The mainstream narrative will continue to frame this as a commodity story. They'll talk about mining output and solar demand. They won't tell you that this is a structural reordering. The price you see quoted is increasingly a fictional number, disconnected from the physical reality of availability. China learned from being on the receiving end of this game in the 1930s. Now they're using the same playbook, but they control the board. The real game being played. So this is the real game. Silver sits at the crossroads of money, industry, and power. China's strategy is now visible. Build monetary trust with gold, and control industrial destiny with silver. This provides the two pillars for an alternative financial system, one with tangible leverage. This isn't about predicting the next price move. It's about understanding that in a fragmenting world, control over critical materials is the ultimate currency. When you control processing and exports, you don't just set a price. You decide who gets to build the future and who has to ask permission. The mechanism is now operational. The only question left is whether the West even understands the game being played.